Brad Friedlander, 55% of your Angel Oak multi-strategy fund is in non-agency mortgage bonds. What's wrong with Fannies and Freddies?
Well, the biggest risk with Fannie and Freddie as it pertains to the current environment is interest rate risk. We're at a time now where the 10-year is at 2.5%. I'd argue that a lot of the data that we've seen of late doesn't coincide or is really not consistent with rates being that low. Fannie and Freddie debt, often being fixed rate, is exposed to a higher interest rate environment. That's where we're most concerned. Also, the good portion of that world is actually trading at a premium north of par. So when you see significant paydowns and prepayment on a monthly basis in that's going to dilute your yields.
All right, let's talk about mortgages since you own a lot of mortgage bonds. What's the state of the housing market? We got some pretty average to poor numbers early on in the year, but we got a good April construction number. Where do you see the housing market?
Yeah, even the housing market was not immune to the winter doldrums that we saw over the worst parts of January, February. We begin to see that part of the markets begin to work their way out of that winter softness. Housing starts is another point that's picked up significantly over the $1 million mark again. So we would expect that the momentum should pick up back again. That's something that from a thesis standpoint, stand behind.
And you guys pay what, 5.1% monthly? It's a pretty nice yield, and it's hard to find yield out there.
Yeah, our dividend yield has picked up a bit of late. We are currently passing through over 5% that is paid monthly. It's difficult to find yield in this environment, and we're continuing to search and scour the fixed income universe for the best opportunities.
All right, and speaking of that universe, about 19 or 20% of your fund is in CLOs. These are supposed to do well when rates rise, but rates aren't rising. So how does that affect the way you manage money?
Yeah, we continue to find CLOs to be an attractive contributor within the portfolio. It plays a defined role within the fund. Contributing yields north of 5–6% within the fund. It's a wonderful alternative, in my opinion, to high yield or even to many of the floating rate bank loan or bank loan type vehicles that you've seen of late, because it offers structure, it offers protection, and you're not in a first loss position. So those are things that are really important to us.
All right, thanks a lot, Brad.
Great, nice to meet you.
And thank you for watching The Street.